Okay, alright. Hello all, hello traders, and this is Shlomo Cooper for Trading, and this is our weekly investors club as we wish to open and to look forward into this exciting week ahead of us. So what we going to talk about in the next hour? First of all, as always, we are going to make a full and in-depth technical analysis to the markets as well as fundamental analysis, and we are going to see where the market is expected to go from here after Janet Yellen, as expected, hugged the rates for the first time in 2017 last week on Wednesday. As the market is celebrating these days its 8 years of bull cycle, we are going to see where this cycle is listed among all other bull markets in history of the S&P 500. We are going to take a look at one of the biggest loss that a hedge fund manager made in recent years, and this is Bill Ackman. You can see him right now in the picture, and his hedge fund Pershing Square has declared a massive loss of $4 billion on VRX on one trade, and we are going actually to analyze his trade and to find 3 mistakes that is very common mistakes that even rookie traders are doing, and he actually behaved like a rookie trader on that trade, and what we can actually get and learn from his trade. And at the end, we're going to take a look on Snapchat actually went out as a very excited and hot IPO, but since its debut it went down to 29%. But why I claim that we may see a boost in its price very soon. All right, so lots to talk about. Let's start, and I'll just roll back. Okay, so first of all, I want us to look at the market, and this is the S&P 500 chart, intraday chart, 30 minutes each bar, and we can see here Monday till Friday bars of 30 minutes. And if it wasn't for a 2-hour rally following the Fed interest rate announcement on Wednesday afternoon, the indices would have been completely dead last week. There was a brief celebration, based on the view that the Fed was more dovish than expected, but after that, the momentum actually completely dried up, and as you can see, even on Friday, the market ended at the low of the day, and by the way, gave back all the brief momentum it enjoyed early after the announcement, the interest rate announcement. So far in March, and I'll just try to bring up the Colmex platform, because I want us to see the market right now on the chart. So let me I'll just try to broadcast my screen. So let's see if I can do that. 1 minute. Okay, or maybe I'll use another one. Okay, I'll use this chart. So so far in March, the market has failed to build on 2 rally attempts. One attempt we had, you won't be able to see it there. So 1 minute, I'll just try to bring here the chart. So for some reason I'm not able to see anything on my chart. Don't know why. Just use another platform, something on. Okay, finally live. Alright, so this is the SPY data that tracks the S&P 500 on the daily chart, and as you can see right now, we had 2 attempts of rallying up. The first one was on Wednesday 2 weeks ago. That was after President Trump addressed the Congress. Actually, it was a head fake, and from that, actually, the market closed the gap, went down back to the rising 20 days moving average. You can see it here on the light blue line. And the second one was after Janet Yellen, chairwoman president, Federal Reserve president, actually announced on a rate hike, and but there was no follow through after the first pop-up. So the market actually has failed to build on these two rally attempts. There hasn't been any rush for the exits, but the inability to generate better momentum is somehow troubling. On the other hand, we have to say that the bears are even more incapable and cannot, do anything when the ball is in their hands, when they are given an opportunity. The bears, of course, continue to grow louder and louder about how a slew of negatives are lining up, but the price action has refused, so far at least, to cooperate. There are some cracks appearing in the foundation, but rushing to play defense has been a costly endeavor in this market. It wasn't a very, very successful strategy. Now, intentionally, I put this adage on the intraday action of last week's market behavior. Price action, everything takes time. Bees have to move very fast in order to stay still, and that expression crossed my mind when I contemplated about recent price action this weekend. Now, over the past year, one of the most significant pattern, and I'll switch back to the daily chart of the S&P 500. One of the very, very common pattern that we saw in the market has been long periods of very flat action. So we had last summer and fall. Just look on here on the SPY. We had it. Okay, we had it. Okay, in the summer. Okay, we had it in the summer when we had a very, very tight trading range, and then from mid-December till the end of January, very, very tight range. Now, now tight trading ranges and limited volatility in the indices aren't anything new, but there is one big difference about the action in recent years. It impacts almost every stock in the entire market. Prior to the Great Recession in 2008, 2009, many traders that I was associated with would look forward to days actually when the indices had limited movement. What would happen is that there would still be some very good tradable action in a few stocks, and that action would stand out and be even easier, to catch. Traders would gravitate toward the hot stocks and would help to create pockets of strong momentum. Some of our, best days of trading would occur when the indices barely moved. That no longer occurs to the degree it once did. These days, in our market, when there is flat action, it hits the entire market, and the pockets of momentum do not stick out. There are always a few things that make outsized moves, but the action is much more challenging for human traders because nearly all stocks are moving in lockstep, are moving together. There is no big mystery about what has changed, and I talked about it a couple of weeks ago here in the Investors Club. And first and foremost, the market is now driven to a much greater degree by the indices and related ETFs. The index ETFs are the tail that wags the dog. When the indices trade in a tight range, all the underlying stocks that make up those indices move in lockstep and do little. There are limited pockets of momentum because it is the indices that are determining the movement rather than the characteristics of the individual stocks, and that was not the case years ago. Also, and that is the other thing, the other dominant player in the market, and what causes the market to trade in a very tight range for long periods of time. The computer algorithms, which trade most of the volume these days, don't need high levels of volatility to make money. They trade massive amounts of volume and are happy to extract a few pennies of profit on each share. They are like bees that are making so many small movements so fast that they look like they aren't moving at all. This is the reason why some of the major brokerage houses can go months without a losing day, even one losing day. They don't have it. They have an advantage, they have an edge of both great size and great speed. They control the flow of price action and have an advantage when they can benefit from a movement of a fraction of a penny. Flat action now can be just, plain boring for human traders who are trying to find some hitters. They must be much more selective and they run a much higher risk of being caught leaning the wrong way when a buy or sell program hits and causes the entire market to react. Despite this dynamic, individual stock picking is still the best way, still our best way to produce superior market returns. It just is more challenging and requires more patience. Traders need to be aware of this dynamic and need to tolerate days like, for example, the day of Thursday, where we almost had no action at all. All right, when there is hardly any movement at all. Now, traditional technical analysis teaches us that the longer a base, the bigger the subsequent move afterwards. But that no longer works like it once did. Human traders tend to grow very frustrated with flat action and react by becoming more and more anticipatory. When the market doesn't move much, it is hard to resist the temptation to make a prediction about how we are on the brink of a huge move. Much of it is simply, a desire to escape boredom and be more active, but it can cause bad decisions when we become impatient and restless. So these are two things to keep in mind as we contemplate the market today. First is that these tight ranges tend to last longer than we might anticipate. the idea that we are setting up for a big move is of great appeal to traders and can cause us to act prematurely, but flat action tends to lead to more flat action. Second, the flat action requires much more, on our behalf, much more selective stock picking. The days of holding a large number of positions and producing superior results are over, guys. It is necessary to be more selective, concentrated, and to manage things tighter. You are fighting the indices that are driving the back of the action and need to change the way you handle your trading, you handle your positions, you handle your individual stocks. Okay, now we are heading into a period where seasonality starts working against the bulls, and there aren't any earnings catalysts. The next big market mover is likely, you know, to have something with something to do with, you know, whether Trump fiscal policy is making any progress or not. So far, it's been all talk and promises, but at some point the market is going to demand some progress, and that will be when the market reacts to the upside or to the downside. Depends on the reaction, whether Trump's administration is going to deliver the deal, is going to deliver the merchandise. Okay, we want to talk a little bit about the celebration of the 8th year of the bull market. And you know, 8 years ago, the greatest buying opportunity in the lifetime of just about everybody came and went with little fanfare. You know, even if you missed the exact low, you know, there have been plenty of opportunities along the way to hop on as the second longest and third strongest bull market of all time charged ahead. In terms of strength, by the way, if the S&P 500 rallied 4% from March the 1st, right, another 4% from this top, 240.32, the current bull will also move into second place in terms of strength as well. No, is there still any path left to ride for this bull? This is the question, you know. Okay, now so right now, you know, relative to the recent gains earlier in this year, equities right now have been taking a rest so far in March, and given the high expectation that tend to accompany higher prices, an increasing number of investors fear that this recent pause is the beginning of the long-awaited pullback that everyone has been waiting for. Keep in mind, though, that whether you look at the last 8 years, the last 6 months of the first, the last 6 months, or the first 2 months of the year, stocks have been on an epic run, and even the most powerful bull need to stop and take a rest every once in a while. You know, they don't always have to collapse, and you know, looking at the chart of the S&P 500 over the last year, the recent sideways trading continues the stair-step patterns. Let's take a look on the staircase patterns. This is the This is the stair-step pattern that the S&P 500 has been in since early February of last year, with the and right now we are just building another stair. Okay. Okay, let's move forward, and right now I'd like to talk about 2 steps to superior returns. If you ask fund managers or a financial planner about the best way to produce good long-term investment results, they will talk about diversification. They talk about risk management, about staying the course, and the variety of other academic theories. There are endless theories about what is the right formula and how to build the portfolio over time. If you are an aggressive trader like me who is looking to produce superior returns quickly, the approach should be quite different. You must throw all the traditional investment management ideas out of the window. You don't focus on mitigating risk by using diversification and longer term holding periods. You have to focus on 2 very different considerations. The first key to generating superior returns is keeping your accounts as close as possible to the highs. Preservation of capital allows your compounding of returns, which is the root of significant gains. Nothing is more unproductive than making up losses. You know the formula. If you are losing 50% of your account, you need to go up 100% just to get to the 0 line. All right, so if you can avoid that, you will be far ahead of the game. This is the area in which a long-term buy and hold is flawed. Buy and hold is great in uptrending markets, but inevitably there will be a major market correction. And individual stocks within a collapse in the market can lose, between 30 to 40% at least of their value in a short term, and that can take a very long time to recap. Stocks do come back over time, and the long-term trend of the market is upward, so the odds still favor positive returns, but you will sacrifice the value of compounding when sitting through those rough periods. Just consider, how long it took to recover after the bear market of 2000 and the next bear market of the millennium in 2008 and 2009. Even if your stock picking was superior, you still suffered a long period of dead money and lost the advantage of compounding. Now, the second key to superior returns is to be aggressive when you have an edge, when you have the advantage. A few home runs over the years are all you need to produce superior returns if you are protecting capital well. Legendary investor Stanley Druckenmiller sums it up very well, and I just took his quote here in the slide that is shown to you, and let's read it together. It's not whether you are right or wrong that is important, but how much money you make when you are right and how much you lose when you are wrong. You are not going to make money talking about risk-adjusted returns and diversification. You've got to identify the big opportunities and go for them. While the logic here is compelling, the problem is that these two steps are inherently inconsistent. If you are swinging for home runs, the second key, then you will be handicapped at holding your account as close to highs as possible. Aggressiveness, if you think about it, requires you to take risk, and risk is what can impair your capital when you are wrong, when you are on the wrong side. Once we acknowledge this inconsistency, the challenge becomes finding the potential home runs but still controlling risk. This is what trips up most traders. No, in my own trading, I know that I'm often quite frustrated when I identify a very good opportunity but then fail to play it aggressively. No, I don't take a big enough position, or I lock in gains prematurely. It takes courage to aggressively ride a profit when we are constantly warned about the need for diversification and risk control. It is never going to be simple or easy to be highly aggressive with trades with high potential, okay? Because we need to make mental adjustment to handle the increased stress such an approach generates. And the best way, to do that is to make sure we have a clear plan in mind when we enter trade. If you have a plan, then we can deal with the emotional ups and downs that are caused by meaningless volatility. When we don't have a clear plan, we are much more inclined to take needless action when fear or worry flares up. If we can anticipate various scenarios, then we are much better able to deal with them in a prudent manner. Advanced planning almost always produces better decisions than emotional reactions. Ultimately, your financial success will be determined to a great degree by your stock picks, but to really leverage your results and produce big returns, make sure you focus on two things. First, protect capital zealously and keep accounts close to highs as possible. And second, when you identify a good opportunity, press your advantage and try to hit a home run. Okay. Let's discuss in more detail. The challenge of managing risk while aggressively pursuing a trade, and the relationship between risk and return is not linear, and that is why this two-step approach is the foundation of great wealth for investors and traders alike in the capital market. So we really need to address that issue. The two steps, as we said, to producing superior returns: first, protect capital zealously and keep accounts close to highs, and second, when you identify a good opportunity, be aggressive, press your advantage and try to maximize gains. That is, an easy theory to state, but it is extremely difficult to put into practice. The two steps are inherently inconsistent. If you focus on minimizing losses and keep accounts close to highs as possible, then you will never take on much risk. And if you never embrace higher levels of risk, then it is unlikely you are going to produce any big gains. So that is actually, if we think about it, that is the biggest trader's dilemma. How do we produce outsized gains, but at the same time, within the same breath, control risk? And if you think about it, all trading and investing is actually an attempt to deal with this issue, to give a good answer to this question. If you simply make a series of big bets, you may be lucky, but if you wipe out your capital, you are out of the game. There is a game over flashing on your screen, and that is the ultimate disaster both to trader and investor. And you know, most of us cannot come back. Most of us don't have the means and the opportunity to come back to the game. Now, one of the ironies of money management is that money management in the professional arena is that because the managers, the fund managers, may not have their own money in their funds they are running, they are managing, they may not perceive risk in the same manner you and I would individually. If they produce poor returns and lose, investors, they just raise more money and start all over again. So it is very common on Wall Street for funds to take big risk in hopes of great glory, and if it doesn't work, they can still go out and raise more funds, but they want to get into the Hall of Fame. The way most big funds try to reduce risk is by doing fundamental research. They figure, one minute. Okay, so they're trying to make their fundamental research on the trade they are entering. They figure if they know every detail about a company, they won't be surprised and will be protected. But unfortunately, even the most in-depth research can lead to major mistakes. And we saw a particularly good example of this recently, last week actually, with Bill Ackman and his Valiant Pharmaceuticals, VRX, right now on the weekly chart, on my chart, debacle. Ackman is known for for his very hard research he's making, and yet he took a multi-billion-dollar loss on this stock. Just look how this stock crashed from $263 per share in mid-2015 till about $11 today. This is a plunge of 95%, and in a minute I'm going to talk about the trade it took and three very common mistakes that a rookie trader is making, and actually plagued also Bill Ackman. Now so fundamental research cannot fully protect you. You have to understand this. And the most important thing a trader or investor can realize is that they will be wrong. Okay, they will be wrong. It may be all traders, even the best, are wrong. Okay, it may just be bad luck, it may be bad timing, but you will make poor decisions and you will lose money. Once you embrace the fact that losing money is inevitable, you can deal with it more effectively. I like to think of losses when it comes to my trading as one of the routine costs of trading. A normal business would budget a certain amount of money for an expense such as this. So traders essentially can do that by setting stop levels. Once you hit a certain level, you have used up your budget and you must close the trade. There is no other alternative at this point. Of course, that is not how people tend to think and react when a trade is going against them. Unfortunately, of course. They come up with, and just think of you, all traders, me and you alike, we come up with justifications for why our initial decision was not wrong and why they should exceed this time, only this time, their budget for losses. Even worse, they start to look for reasons to add more money to a trade that isn't working, that is failing. If you are going to manage risk, you have to be disciplined. That is the heart and soul of it. We are dealing with managing risk. This is our edge. This is what investment and trading is all about. Managing risk. We are not trading stocks. We are managing risks. There must be hard and fast rules that you apply no matter what happens. And this is the mistake that Bill Ackman made. He did not have some sort of methodology to cut his losses at some point. He trusted in his research and refused to take the loss. And that can work, for you sometimes, but when it doesn't, the pain can be enormous, and VRX is a great demonstration of that concept. For many traders, the challenge isn't protecting capital and limited risk. The problem is the other side of the coin. The problem is not taking on enough risk. They grow comfortable with grinding out smaller returns and don't push to go for the big win. So you get $100 from this and $50 from that, but you cannot grow your account by these penny trades, One sure sign you aren't trading big enough is if you have no worry. If you enter a stock and you are very, very comfortable with it, you should be at least a little nervous about the trade after entering it. If you are unlikely to suffer any pain, if you are wrong, then you are very unlikely to generate a huge profit if you are right. Good trades should stir up some emotions, but you manage those emotions by being confident that you can handle things if they go wrong. You must be optimistic enough about a trade to reach, but you also must be disciplined enough to deal with mistakes. If you never feel at least a little uncomfortable, you are not trading big enough. Let me tell you that. Now, optimism is a good trait for traders to cultivate, but it has to be combined with discipline. You can be more optimistic when you are confident you have a solid plan for dealing with what happens. One of the best ways to be more aggressive is to focus on adding to winning trades. When something is working, stick with it and push it. big gains are all about catching momentum, all right? So when you latch onto it, the normal inclination is to hurry, and take some profits, to log some profits, to put some profits in your pockets so you can declare a victory. And this is the opium for traders, because it's not about I made $100 on that trade and I lost $400 on that trade, because a normal trader will say, all right, I'm about balance because I have a 50-50 win ratio. But your trading account has a memory. It remembers everything, and for that, so it does matter how much money you bring back to your account, how much money your balance is going up after a good trade, and how much money your account needs to pay back after a loser. However, when a trade is really working, that is usually the time to add to it and try to extract something extra. You still must maintain your discipline on that trade, but riding strong momentum can carry less risk than trying to pick turning points in the market or in individual stock. Finding ways to be aggressive, if I'm summing it all up. So finding ways to be aggressive while minimizing risk is what all investing and trading is about. The first step is to simply be cognizant of the relationship. Okay, you aren't going to make big money without risk, but you must manage that risk aggressively in order to avoid impairing capital. Okay, with that in mind, let's talk about Bill Ackman and what the heck happened there in the very, very misery trade on VRX. So there was lots of talk in the media last week about Bill Ackman's Pershing Square hedge fund dumping the last of his stock in Valiant Pharmaceuticals VRX and taking a loss of about $2.8 billion, and that actually overall came up to $4 billion since this trade began. Some of the talk is, just taking pleasure in the pain of others, but it really is remarkable to see a high-profile hedge fund manager handle a position like, he was a rookie in the first grade. Now, Ackman is lucky that he had sufficient capital to handle this loss, but for most folks, it would have been a death knell. When smaller traders blow up their account, they almost always do it in the same manner that Ackman handled his investment. So this is, as we saw earlier, this is actually what happened in VRX, and this is the plunge since it hit the all-time at $263 per share in mid-2015. It plunged by about 95%, and it's trading today for less than $11 per share. This is a massive plunge in the stock price, and I wanted actually to analyze this trade and to come up with 3 trading mistakes that Ackman made on this trade. So let's start with the first mistake. The first mistake he made was, and we actually can learn a lot about it and about ourselves and what is right and what is wrong, from what to defer when we are trading and what to embrace when we are trading. And this is actually the treat, and this is actually the merit of analyzing other traders' mistake. So the first mistake he made was becoming emotionally attached to the stock. Once you do this, then you tend to overlook issues that you shouldn't. Ackman said he knew that there were problems once he became a board member, but he ignored them. You have to wonder, if that same emotional attachment occurred in the very famous short trade he made on Herbalife, that also actually caused him a big loss of $1 billion, and actually we covered that trade 1 year ago here in the Investors Club. The second mistake he made was averaging down into a losing investment. And that can work well when you have a predetermined plan to build a position, but that was not the case here. As the stock continues to fall, Ackman was anxious to show his confidence in the company and continued to buy more and more shares. So it wasn't the plan initially, and he ended up putting more capital at risk than was prudent. Ackman's third mistake was that there was no clear risk control. Even if you are a pure fundamental investor that believes in the stock you are buying, there has to be a point where you take into account the price action. Perhaps the market is irrational, perhaps the market is wrong, perhaps investors are not seeing what you are seeing right now, but perhaps you are the most smartest investor on Mother's Earth, but there needs to be a tipping point where you say enough is enough. You cut your losses and move on to the next trade, to the next investment. You don't wait until you lose 90% of your investment before dumping a position that isn't working. Your sales may not be optimal and may feel downright wrong, but your first job as a risk controller is to always protect capital, regardless of how much you might believe in a stock. So, this is just, a great illustration of what not to do. And what I find, most interesting about it is that a big shot hedge fund manager fell into, the same sort of emotional thinking that plagues novice traders in the first grade. It shows how difficult it is, to be consistently disciplined. Discipline is something that grows over time. This is something that you achieve over the course of time, but it's not something that you actually learn it. Okay, it's something you absorb. It's a process. It's a personal process that you develop into it, that you are almost reborn into it. I want to finish today's presentation talking about a Snapchat and why I think we could see soon a rally in this stock. So you all probably have been aware of a Snapchat, and that was a very hot IPO 2 weeks ago. It was very excited, one of the biggest technology IPO in recent years. And even though it's only been 2 weeks since the public offering of Snapchat, there has already been plenty of gut-wrenching volatility. After a 44% pop on its first day of trading, Snap shares quickly trailed off, and right now Snap is 29% of its high. Yet this should not be surprising, and let's face it, whenever you make a bet on a new cutting-edge technology, you should expect a roller coaster ride. And a spot on case study of this is actually Facebook. Facebook, after its debut in May 2012, let's get back to there. Okay, actually, it was out at $38 per share, but actually, as you can see right now, the stock price would go on to tumble by about 50% till actually it bottomed down around $70 per share, 17.55 in 3 months. But of course, selling into this selling off period would have turned out to be a very big mistake. A very big mistake because just take a look at what happened to Facebook price. Okay, it went up massively. Actually, it's up 3.5 times its IPO price and 8.5 times its lowest value of 17.555. Right now it's trading for, we aren't even seeing the end of the chart. Right, this is $80. It's trading right now for about 140 if I remember correctly. Let's take a look at the monthly chart. Okay, this is the monthly chart. All right, just take a look at on this where Facebook is trading right now. Okay, so now let's understand what's happening to Snapchat and back to Snap on the daily chart. So when it comes to IPO investing, first of all, it's important to keep in mind that the swings in valuation are not just about fundamentals. In fact, the technical factors can have even more of an impact. The reason is that a new issue is getting seasoned in the market. Actually, a key part of this process is short selling. And to see how, let's take an example. Suppose John buys 100 shares of Snap stock through his margin account at Colmex. And by doing this, he has allowed Colmex to lend these shares to short sellers. Next, you want to short 100 shares of Snap stock. Since you think probably that the valuation is crazy and believe the price will continue to fall and everything around Snap is nothing but hype. You do this through your Colmex account by borrowing the stock and then selling it on the market. So this means you are required to, in the future of course, to buy back the 100 shares to close out the trade. Hopefully, the share price is going to go down in its price and then you are going to make a profit. Now, if this is at a lower price, of course, then you will have made a profit. Essentially, when shorting, if you think about it, you are selling first and buying later. Now, let's say that when you sold your 100 shares, the buyer happened to be named Jane. So, notice something. And this is something that usually we are overlooking. John owns 100 shares. He was the first buyer. And so does Jane. Jane also owns 100 shares, so these are together, combined, 200 shares, although only 100 shares were debut. Okay, so in other words, 100 shares have been created. Another 100 shares have been creating. Yes, short selling actually increases the float of a company's shares. So for a new issue like Snap stock, this can mean lots of pressure in the early phases. This is due not just to the actual sales by the short sellers, but all the extra stock that is dumped on the market from investors. It's essentially a double whammy. But all this is
really a short-term thing. After all, the initial IPO of stock is generally small, and for instance, in this case of a Snap IPO, the company sold 200 million shares, and of that, 50 million shares are subject to a lock-up period for 1 year. Yet there is something to keep in mind. Let's get back to the slideshow. And that is, the short selling process will eventually unwind and creating demand for the shares. Sometimes this is because the stock price has fallen to low levels, and investors buy back their position. Or there may be a short squeeze, and this is where the stock price spikes and essentially forces short sellers to get out of their positions. Now, with Snap stock, there could ultimately be a setup for a short squeeze. In about 2 weeks or so, with what we call the quiet period. The quiet period will expire, and this will allow the underwriters for Snap to publish their analyst reports. Actually, the quiet period means that all the underwriters that actually made the process of this IPO, they may not issue any recommendation of the stock. They must shut up. Okay, but after a month or so, they may start to publish their recommendation for the stock. So if history is any guide, they will likely be upbeat. Oh, and these underwriters have substantial investor bases that will likely get excited to buy up the stock, especially since the valuation now is lower. It also, helps that Snap has come off the largest Wall Street banks as underwriters like Morgan Stanley and Goldman Sachs and JP Morgan and Deutsche Bank were among the leader underwriters. There will also be Snapchat's first earnings report soon, actually during April, which should show torrid growth. The company is still, in the early stages of monetizing its user base, so it should not be too difficult to pump up the top line. So considering all this, plus the heavy bearish sentiment, Snap stock could be poised for a move on the upside, at least in the near term. Okay, we'll get back to Snap in a couple of weeks. Alright, thank you very much all for being here with me. Hopefully this is interesting analysis, and it helps you, to gather your ideas, just to set up your way towards this new week. So thank you very much for attending and for being here with me. My email is always at the bottom of each slide, and this is shlomo@tradenet.com. Wish you all the well and very, very successful trading week. Okay, and I'll be back with you in another week with another Investors Club. Thank you all very, very much.